Do you have a friend or a family member who you would loan money to without question? And do you have another one who you would never lend money to, or if you do, know you'll never see it again? What's the difference? This is the dilemma that lenders face when trying to decide if they want to lend money to you. They don't know you, so you have to prove whether you're trustworthy. And that's what we're going to discuss in this lesson. What are lenders looking for when deciding if you're eligible for a home loan? Wouldn't it be nice if you could just peek behind the curtain and know exactly how to boost your chances? That's what we're going to do. Hi again, it's Steve Ramsey, your friendly neighborhood loan officer, and your trusted guide on this home ownership journey. Today I'm going to show you exactly what lenders look at when they're trying to decide whether you qualify for a home loan. And more importantly, how can you prepare to make the best impression possible? Here's exactly what lenders examine when reviewing your loan application. There are 4 things. First is your credit score and history, your income and stability, your debt to income ratio, and finally, your savings and assets. So let's look at each of these more in depth. First is your credit score and history. Your credit score helps lenders predict how you'll handle loan payments by looking at how you've handled them in the past and how you're handling them right now. They look at your loans that you've had, the loans you currently have. Did you pay them? Were you late? Are you behind on any now? They look for all of these items. Secondly, we need to note that the higher credit scores usually mean you'll get better loan terms. While you still may qualify for a loan with a 640, if you could raise that to a 680 or 700, the percentage rate of your loan could significantly drop. That will vary depending on the loan program and the particular lender, but just know the higher your credit score, the more options you often have. So one of the first things you want to do is check your credit early, correct any mistakes, because sometimes there are mistakes. Things get left on there for years that you don't realize are on there. Items you've paid off and yet were never reported as paid off. So check your credit score early, look for any errors, and avoid any large new debts that as you lead up to your loan application. Number 2 is income stability. Lenders like to see consistent, predictable income. Typically, employment or steady business income over the last 2 years. It's fine if you switch jobs recently, as long as you're staying in the same line of work. If you've changed careers, it isn't the end of the world, but it does make lenders a little bit more nervous. So one of the things you want to do is to keep your income documents organized. Keep your pay stubs present, keep your tax returns available, any bank statements, and all of these things your loan officer is going to ask for. Typically, we want the last 2 pay stubs and the last 2 bank statements in order to show this income stability. If you're self-employed, it makes it a little more challenging, but it's definitely doable. There's many loan programs that work for people who are self-employed. So we call these 1099 people because we don't have a W-2 or an employer type situation. So if you're a 1099 self-employed person, we're typically going to need to have 2 years of tax returns to show that you've consistently made money in your business. Number 3 is DTI, which stands for the debt to income ratio. I have a calculator for this on my website. If you go to steveramseyloans.com and then at the top choose loan tools, you can see a calculator there that will give you your DTI. But basically what the DTI is it compares your monthly income compared to your monthly debt. So everything's based off of the month. We don't care about annual or weekly or biweekly. Everything's figured off of the month standard. Most lenders prefer that your total debt, including your new house payment, be below 43% of your income. Now that is just a broad percentage. Every loan program is a little bit different. A conventional loan will have a different number than a USDA loan, which has a different number than an FHA loan. So that 43% is a nice number to aim for, but just know different loan programs are going to have different percentages that they want you to meet. But it's nice to know ahead of time what your DTI is so you can better position yourself to get that loan. One of the tips that's really powerful in this is to pay off smaller debts or lower balances on your credit cards. So for example, if you have 3 credit cards and one of them has a $300 balance, one of them has a $500 balance, and one has a $10,000 balance, pay off the 2 lower balances first so that all you have left is that $10,000 balance. That in and of itself will greatly improve your debt to income ratio. If you want to go, again, if you want an easy way to figure this, go to my website, steveramseyloans.com, look for loan tools at the top and scroll down and choose the DTI calculator. Finally, number 4, savings and assets. Lenders want to review your savings, your checking account, your savings accounts, any kind of retirement funds you have to ensure that you can cover the down payment, cover closing costs, and cover any kind of emergencies that may arise. So this involves looking at your current bank accounts to see how much cash you have on hand. They may even consider things like your retirement accounts like we mentioned. It just depends on the account. The things that they're going to consider are items that are considered liquid. So if you have a bunch of properties, that's great, but that's not very liquid, because in order to access the money from those properties, you'd have to sell them or refinance, or etc. So they really want to focus on your checking account and your savings accounts. Showing lenders that you have a little extra cushion helps lenders to feel more confident in approving your loan, because it shows that you have something to fall back on if things go bad. So one of the things you want to do, one of the tips you want to follow, is that you want to keep your savings stable during this loan process. Try to avoid large unexplained deposits or withdrawals. You don't want to have to explain why grandma gave you $10,000 suddenly, or you don't want to withdraw $10,000 out for that vacation all of a sudden. Try to keep things stable. I've been exactly where you are, preparing financial documents and hoping everything aligns. I get it. The process can feel intimidating. It's a lot of work, but in the end, think of it as your opportunity to showcase your strengths, to prove yourself as a reliable and trustworthy client for that lender. Why would they want to lend you money? This is your chance to show them that they can trust you. Well, great job making it through this lesson. Now that you know exactly how lenders assess your readiness for a home loan, let's dive into the next exciting step, which is choosing your home and making an offer. This is where things get really exciting. I'll see you in the next lesson.